We're doing a sample financial analysis of Best Buy, and this is just to expose you to a 10K, pretty daunting looking document, and see if you can make a little quick assessment of how the company is doing. First part is just to get familiar with the website the company has, as well as their 10K, to look at what is their mission, what is their strategy, what is their position regarding governance. And there are many proper answers to this, but I just put a few examples of what you might look at, and we have the following. We see that they describe themselves as a retailer for consumer products, services, and they are now increasingly moving into other lines of business, such as health products and health services. They did have a failed attempt at some online or other attempts in Canada and Best Buy Mobile, so they've pulled back on some initiatives. So in a way, they're a very strong, high market share retailer, but they've had some failed attempts at expanding their lines of business. So one of their challenges going forward is what growth vehicles might they have in order to sustain the growth of Best Buy as a company. The strategy comes from their Form 10K and describes what their idea is for their technology products, both now and into the future. And the next part deals with corporate responsibility. This was found on their website in an area that was including investor relations, but also corporate governance and describing a little bit about other things important to the company and its board of directors, such as sustainability and their practices as a purveyor of products that utilize some fair amount of capital resources and environmental resources. Their goals are to look at carbon emissions as a way for them to perhaps contribute to sustainability efforts. So that was the first thing, just to get your bearings on who is the company, what they do, and some of the values that govern the company. Looking at their financial statement, we start with the income statement. We just grab two numbers, the revenues and the net income for the 2 years presented of 2019 and 2018. And we see that over that time period, the revenues grew by about $600 or $700 million, and their profits grew by about $460 million. So that's a pretty good year for them. Their profit margin went up from 2.4% to 3.4%, which means for every dollar they sell, they make 3.4 cents. Now, this is an improvement over the prior year, and also given the very expensive nature of running a retail business, it's a very competitive, commodity-based, low-margin business. So this is not surprising that the margins for this business are very low, even though they are one of the market leaders. The next item is the balance sheet. Here we again grabbed a couple of numbers, their assets, liabilities, and equity. And what we find is that 74% of their assets were acquired by borrowing money from their vendors and also from their lenders. In the prior year, for 2018, that figure was 72.3. So for the last 2 years, they've had pretty high leverage, where they had high levels of debt compared to the amount of equity in the company. And this introduces some risk, because if you have a lot of debt, then if you miss a payment, then you give some power over to the lenders to do things like enforce security agreements, or ultimately they could put you into bankruptcy. So it's something to be very wary of if you're managing the financial affairs of any company, is to find that proper level of debt where you can comfortably make the payments so as not to jeopardize the continuity of the business. In this case, they are having fairly small equity and therefore putting the business at some risk if they were to miss on their payments. The next section is a statement of shareholders' equity, where we look at, again, a couple of numbers. First, look at the profits they earned and how much dividends they paid. And lastly, just a different non-monetary number, which is how many shares have they repurchased. And what we see is that they make a fair amount of profit, as we've seen before, but they also pay a fair amount of dividends. The ratio of what percent of their profits they pay out to their shareholders is 33.9% in 2019 compared to 41% in 2018. So they pay a fairly high percent of their profits to their shareholders. And guess what they did with the rest of the money? They used that money to buy back shares. So if you were a shareholder of Best Buy, you would get benefit two ways. One, you get a check in the mail every 3 months for dividend. And secondly, since they're compressing the number of shares outstanding while increasing the value of the company, the share price should be going up. So as a shareholder, you should be pretty happy. You get cash return by way of dividends, and you get to see your money and your investment value go up based on the share price. And in recent years, Best Buy has been a pretty strong stock performer, even outperforming the S&P 500. The last statement of the four is the statement of cash flows. Statement of cash flows are broken into three sections: operating, investing, and financing. Operating meaning how well did they do generating cash from running the business. Investing meaning what are they doing by way of increasing their property, plant, equipment, in their case like stores or warehouses, or their long-term investments in securities that create a bit of a war chest, if you will, for future expansions or acquisitions. And financing is how did they pay for it all? Are they net borrowing money or raising money, or are they net paying back? What we see with Best Buy is a very clear pattern. They make a fair amount of money. In 2018, they earned $2.1 billion. In 2019, they earned $2.4 billion. What did they do with the money? In 2018, they were aggressively building more property, plant, equipment. In 2019, they also had growth in property, plant, equipment, but they sold off many of their marketable securities to enable them to make those improvements, as well as to fund their aggressive stock repurchase program. In both 18 and 19, they did negatives in the cash from financing because they are net paying out money by way of dividends and by way of the stock repurchases. So that's what they've been doing very clearly for the last few years, not just these 2 years, but if you look back in 2017, they also had the same pattern. And the observation is that they're generating a lot of money, they're building their business, and they're very aggressively looking toward conveying value to their shareholders. So the last part is just overall, what do you think of the company so far? Well, it seems like a very solid company, a market leader in retail electronics, toys, if you will, for adults for Christmas and all year. And secondly, they generate, from the strong company position, generate a lot of cash and profits, which they then use to provide cash dividends to their shareholders, as well as actively do things such as stock repurchase agreements to increase the amount of stock price so that the shareholders are happy with both cash returns and stock appreciation. So that's it for a very brief introduction to financial statement analysis. When we move to the next section of financial acumen, we'll go far deeper into financial analysis where you could probe a little bit more to figure out what's really going on with the company.